Hey traders, Lance here. I'm going to go over a hedge. That's right, I said the H word in an S&P 500 stock, but what you're going to love about this video, it offers you a little bit of risk for a maximum reward if we sell off. So personally, I'm looking at TXN. It's a semiconductor stock with China exposure. If we sell off, I think it's going to be China related. They've had buybacks, they lowered guidance, and to be honest with you, I just don't see any growth with the exposure to China. I think if the S&P 500 takes a hit, it takes a big hit on the chin. And the chart pattern from the gap down on earnings, not only do we have the gap lower, but I see a bear flag formation. So here's the flagpole, and then here's the flag. If we take out 115, which is support, I think we trade down to about 110, possibly all the way down to about 105. So I'm not looking, for a massive market decline. I'm just looking for a move lower, about $7 or so in TXN, which I think if the S&P falls, let's say 3 to 5%, we can get pretty easy. So let's go to the options market and see what we can get for a bear put spread. That's right, a bear put spread is going to be our hedge. So let's go ahead and look. TXN, I'm looking at December, so that's 32 days. For expiration. Now those 115 puts, they're about 160 here. So I'm going to look to buy these 115 puts in TXN because that's where I think if it breaks support, it's going to fall. And then my target, or where I think it can go, is about 110 or below. So I'm actually going to look to sell here on the bid the 110 puts here in TXN. Now you can see for the trade, it's about a dollar debit, okay? So I'm risking $100 per one contract. Now, the spread is $5 wide. What that means is, let's actually analyze this trade to see. What this means is, I'm risking $1 or $100 per contract to potentially make, if TXN is below 110 at expiration in December, $400. So I'm risking 100 to make $400. That's a phenomenal risk versus reward as a hedge if TXN moves lower, an S&P 500 stock here. Now my max loss, that's always something you want to look at on this trade. If TXN, let's say they announce a buyout and the stock trades 130 tomorrow, I can only lose $100. So my maximum risk is capped. I can only lose that $100 per contract. Now, if TXN, let's say, doomsday happens and the CEO steps down and the whole market tanks, my max reward, the most I can make, is that $400 here on the trade. So I'm risking $100. My max loss. You always want to look at your max loss per one contract to potentially make $400. My max gain is capped. So I know exactly where I stand in the trade at all times. If TXN is below 110, collect that $400, that spread, $5 wide spread, minus the $100 you pay, that's $400. I'm risking 100 to make 400 if TXN falls below 110 by December expiration. That's what we call a bear put, and it is a debit spread. So I'm actually paying for this spread as a hedge here in the S&P 500 and the stock TXN text instruments. Lance here, let me know what you think about the trade or your favorite hedging techniques. I've heard some bear put flies out there. I've seen some ratioed spreads, some calendars out there, outright puts for you option traders out there. I'm looking at a bear put debit spread.